All right, so let's look at chapter 6, question number 1. The fruit smoothie. All right, Prime began the year with 4,200 credit balance and allowance for doubtful accounts. During the year, it accrued 21,500 of bad debt expense, wrote up accounts receivable of 28,000 at year end. Percentage of outstanding accounts receivable indicated that $4,800 allowance should be provided for on that date. The year end adjustment for bad debt expense should be. No, this is I'm leaving that up to you. Anything that's on the midterm that we need to cover, we'll hit that on Thursday. So go back over that. Make sure you know how to do all those problems. But I'm going to cover the new stuff today. Okay. All right. Okay. So first thing my brain says, I'm a visual learner, so my brain says draw T account. All right. So allowance for doubtful accounts. What type of account? Hmm. What is it? What are allowance for doubtful accounts? Exactly. Customers that will not pay, right? Okay, we know not everybody's going to pay. So what account does it go along with? No. Where are the customers that are going to pay? What account? Where's their balance? Accounts receivable. Exactly. How do we record accounts receivable? What does GAAP say? What value? Net realizable value. How do we get accounts receivable that's recorded at historical cost, right? Historical cost principle. It's recorded at historical cost. How do we adjust it down to net realizable value? Allowance for doubtful accounts. So this, what type of account is it? Contra asset. So it means its normal balance is what? Debit or credit? Credit. Okay, because it's a contra asset, so normal balance is credit. Okay, good. All right, so looking at this entry then, it says began the year with a $4,200 credit balance and allowance for doubtful accounts. So I'm going to stick that in here. So remember, you can eat a truck if you break it down in small enough pieces, right? So just start putting it down, okay? You know, just put it on a T account. To me, that's the best way to see it, is to put it on a T account. It says during the year, it accrued $21,500 of bad debt expense. What's that entry? To accrue bad debt expense. What is that entry? That's the one we anticipate will not pay. We're accruing for bad debt. We're estimating them now. When we're estimating that $21,500 will go bad, what's the entry? Good. Debit bad debt expense, credit the allowance account, right? Does that make sense? So anytime we accrue an expense, we're going to debit an expense, right? Okay. And of course, the allowance account, that's where we put all the accounts that we believe are going to go bad. And it has a credit balance. So when we are increasing the amount of accounts we think will go bad, we credit allowance for doubtful accounts. Does that make sense? Of course, when you're going to credit an expense account, right? Only if there's an error. Okay? So you're going to debit bad debt expense, credit allowance for doubtful accounts when you are accruing for those bad debts. So then it says you wrote off $28,000 worth of accounts. So if this company is using the allowance method, and they should under U.S. GAAP, they should use the allowance method. How do you write off an account? What's the entry? Good. So we would credit accounts receivable because we've written the account off, and because we've already allowed for the fact that some of those accounts are going to go bad, we're going to debit the allowance account. So if we wrote off $28,000 worth of accounts, it'll be a debit to allowance for doubtful accounts, credit to accounts receivable. So then it says at year end, so now it's year end, and it's time to adjust our allowance account for what it ought to be. So we've looked at our outstanding accounts receivable. So this is balance sheet approach, because we're looking at the accounts receivable account, and it indicates that $4,800 allowance should be provided for on that date. So we've looked at the accounts receivable, and we're estimating that $4,800 worth of those accounts are going to go bad. What's the entry? What's the year-end adjustment for bad debt expense? All it says is that we estimate, says that a percentage of the outstanding accounts receivable indicated that $4,800 allowance should be provided for on that date. So what that means, we want that amount to be a credit balance in this account. Okay, so balance sheet approach, we're looking at the allowance for doubtful accounts, and we are adjusting it to our estimate. Balance sheet approach. Make sense? So right now we have a debit balance of $2,300, and we need to get to a credit balance of $4,800 as indicated by our analysis of the accounts receivable. So in order to get to this credit, what's our entry got to be? Remember what we're doing here. What are we doing? We are accruing for a bad debt expense. We're estimating how much accounts are still going to go bad. How much money? $7,100 is what it's going to take to get us to a $4,800 credit, because that's the $2,300 debit balance plus the $4,800 desired credit balance for a total of $7,100. So what's the entry? Debit that bad debt expense, credit the allowance account. Okay, makes sense? That's balance sheet approach, right? Now, if it was the income statement approach and we estimated that $4,800 worth of accounts were going to go bad, what would be the entry? Yep. What would the entry be? No, all we're doing is estimating bad debts. But if we're using the income statement approach, we're simply looking at the sales account and estimating how many of those are going to go bad. Okay, so did we figure it out? Income statement approach. If we estimate that $4,800 are going to go bad, if it's the income statement approach, we don't care what's in the allowance account. Okay, we're simply going to match the revenue and the expense. So if we estimate $4,800 of bad debt expense, debit bad debt expense for $4,800, credit the allowance account for $4,800. We don't care what's in the allowance account if we're using the income statement approach. Only if we're using the balance sheet approach. Debit bad debt, credit the allowance account. Okay, does that make sense? Because if we're using the income statement approach, we're only interested in just the sales side of it. We're not analyzing the accounts to see how much we think is going to go bad. We're simply saying that historically, X amount of percent has gone bad, so therefore we're going to estimate that's going to be how much will go bad this year. Okay, so income statement approach, we don't care what's in the allowance account. We're simply going to record the entry. All right. Income statement, or the balance sheet approach rather, we do care what's in the account because we are adjusting that to the amount that we believe is going to go bad based on an analysis of the actual accounts receivable. Okay. And we call it balance sheet approach because we're looking at the balance sheet account, the accounts receivable account. Income statement approach, we're looking at the income statement account, which is sales. Okay, good? Good. All right. So that's a good question. Can you do that? Okay. Looking at bank reconciliation. Remember bank reconciliation? Okay. So what were the different types of adjustments? Yes. Okay. So remember when we did a bank reconciliation, what would we reconcile? Cash balance per the company book. No. So remember we had cash balance per company, and then cash balance per bank. And then depending on what the adjustment, we're trying to reconcile to find out what our true cash balance is because our money's in the bank, right? Right. So you've gotten the bank statement at the end of the or the beginning of the month. So banks typically for businesses, they'll cut the bank statement off at the end of the month. Mail you a statement or email you a statement and it shows this is how much money you have left in the bank. And this is all the adjustments, all the different checks and the deposits and everything that came through so that you can reconcile that to your checkbook. Okay, so whether you're an individual or whether you're a company, you get a bank statement if you have demand deposit account, a DDA. Okay, and of course in business, we want to reconcile to make sure that the bank didn't cheat us, right? And to find out how much actual money we have in the bank. So a typical bank statement might show that we have more money in the bank than we actually show on in the checkbook. Exactly. So there could be lots of checks that have not come through the bank yet. Okay. So what would be a typical adjustment? So as you said, it could be that we wrote checks, and as soon as we write a check, we deduct it from the bank account, right? Okay. We deduct it from the bank account, we send it out into the world, and then when that person decides to bring it to the bank, then the bank deducts it and gives them the money, right? So if it has not come back to the bank yet, we call that a what? Outstanding check, because it's outstanding in the world somewhere, right? Okay, so if we have looked at all the checks that we've written during the month and $1,000 worth of them have not come through yet, we've already deducted them here, right? But the bank hasn't seen them yet, but they will eventually show up, we assume, right? They're out in the world. They will eventually show up at the bank, and the bank will take money out of our account and pay that payee their money, right? So what do we do with outstanding checks in a bank reconciliation? We would deduct them from the bank side. So outstanding checks are deducted from the bank side. Does that make sense? Okay. Another thing that could have happened is we made a deposit on the last day of the month or the year, and the bank has not processed it yet because we dropped it in their night box. So the next morning, right. And of course, when we made out the deposit ticket before we put it in the bank drop box, we already recorded the entry. What was the entry? Debit, cash, credit, whatever, sales, accounts receivable, something, right? So we've already recorded it in the checkbook when we made out the deposit. But the bank is not going to process it until the next day when they pull it out of the night box. So what are we going to do with a deposit in transit? Deposit in transit. Deducted. It's a deposit. So, yeah. So we made out the deposit ticket. We dropped it in the night box. We've already added it to our bank balance because we made out the ticket. We took it to the bank. Okay, so in order for us to reconcile, we've already added it in. The bank will add it in tomorrow when they pull it out of the night box. So deposits in transit get added to the bank side. Make sense? Okay, because we've already added them. The bank will add them when it gets to the bank. Okay. The bank charges us a fee for processing all those deposits and checks, right? Good. Exactly. So typically when we receive that bank statement, we see that the bank charged us $30 for a charge. So they've already deducted it out of the account before they printed out the statement. But we didn't know about it until we got the statement. So a bank charge gets deducted on the company side. Okay, that makes sense? Okay, bank charges get, because the bank already deducted it. Okay, good. All right, sometimes we direct a customer to, instead of sending the check to us, to send the check directly to the bank. Maybe it was a note and it was collateral for a loan. So we told the customer, send it to the bank and the bank will pick it up out of their box and deposit it in our bank account. If that happened, we may not know about it until we get the bank statement. So if the bank collected a note for us, right, so the bank's already added it in. As soon as they got the check out of the night box, they added it into our bank statement, but we didn't know about it until we got the statement. So if the customer collected a note for us, what are we going to do with it? Exactly. Right. So if the bank collected a note, we're going to add it onto our side. Okay. All right. What else might have happened? An error. Yes, exactly. So when we get the bank statement and we start comparing all the checks that we wrote to the checks that cleared the bank, we catch an error. We wrote a check down for $150 and it should have been $50. So we have an error that we need to correct. So if we wrote it down for $150 and it should have been $50, we need to add $100 back to our balance because we've deducted too much. Okay, does that make sense? Or if we didn't deduct enough, we need to subtract it. Okay, so if the error is on our books, we're going to correct it on our side. If the bank made an error, guess what? If they cleared that check for $150 and it should have been $50, we're going to call them up and say, hey, put my $100 back in the bank. And all we have to do is show them that canceled check. They're going to look at their records and they're going to put that money back. So if the error is on the bank side, we're going to add it to the bank side, call them up, and they're going to put our money back into the account. Okay, so whoever made the error gets to fix it. Okay, does that make sense? All right. Okay. All right. So yeah, and of course we're going to know that we're right because we're going to get, it's going to balance. Okay, petty cash. Remember petty cash? Okay, so so companies. Exactly. So petty means small. Okay, so petty cash means that we set up a small cash account, and typically you keep it in a cash box so that you can lock it up, keep it safe, so people don't steal it, right? Because anytime you expose money to air, it tends to disappear. So we keep it under lock in a petty cash box, and you typically have one or two employees that are responsible for maintaining the petty cash fund. So if somebody needs cash, you need to run to the store and pick up some toilet paper, right? Because you're out, and that's kind of serious stuff, right? So if you need to run to the store, so you go to the employee that has the petty cash fund, you get a 20, you run to the store, you pick up toilet paper, you bring the receipt back to the employee that's responsible for the money, you give them the change and the receipt, so that now the petty cash box is still whole again, right? They're missing cash, but they have a receipt to show for it. Okay, so anytime there's little purchases like that need to be made, you pull that out of the petty cash fund and you bring back a receipt. Then at the end of the month, when it's time to replenish the petty cash fund, right? Okay, so everything that we spent, we're going to have a receipt for it. So when we write a check, so for example, if if we're supposed to have $500 in the petty cash account, so petty cash, type of account is it? It's still money, right? It's just in cash. So the petty cash would be an asset account, right? So debit balance. So we're not going to touch the petty cash account. It should always be $500, right? Because at the end of the period, we're simply going to replenish it. So when we, at the end of the month, we count the petty cash, and it has $320 in it. But we have receipts of $170 that shows how we spent that money. So that's a total of $490. So we're missing $10. So somebody failed to bring a receipt, or somebody miscounted, or failed to bring back some of the change or something. So we're missing $10. So what we have to do at the end of the month, we only have $320 in the petty cash fund. So we have to bring it back to $500. So we need to write a check for $180. So that check, of course, we're going to credit cash for $180, right? Because we're going to write a check for $180 to bring it back to $500. We have receipts for $170, so we're going to debit all of those accounts. So if you spend it for toilet paper, you're going to debit supplies. If you spend it to validate somebody's parking, you're going to debit parking expense or travel expense or some expense account. So all the receipts you're going to account for that way. Then you have $10 that you don't have a receipt for. Okay, we're going to debit cash over or short for $10. So in this case, we're short $10, so we're going to debit cash over and short. If for some reason somebody brought back too much change and we have more receipts than we need, we would credit cash over and short. Okay, and we use the same account when we're dealing with a cash register. Companies that have a store and a cash register, if the cash register is out of balance by $10 or whatever amount of money, if it's over, then you would credit the cash over and short. If it's short, you would debit cash over and short. So it's just an account where you put those miscellaneous, those small amounts, typically they're small amounts, in order to make it balance. Okay. Oh, and they give the excess to the employee? That's ridiculous. Okay, that's unusual. Okay, but of course, typically it's short, right? Okay. So if the problem were to ask you, okay, if you have $170 worth of receipts and $320 left in the bank account, how much are you going to write the check for? You're still going to write the check for $480. Okay. Or $180, sorry. $180 is what you're going to write the check for. You're going to write it for whatever it takes to bring it back up to the balance. Okay. So even if you're short on receipts, you're going to put the difference to cash over and short. Okay. Does that make sense? So that's going to write your check for. Okay, good. All right. So you understand petty cash. All right, let's see. All right, let's look at this one. During year 6, company wrote off $7,500 in uncollectible accounts receivable. At the end of the year, bad debt expense was estimated using a percent of gross sales. Income statement approach or balance sheet approach? The bad debt expenses is estimated using a percent of gross sales. Income statement approach. Good. So remember, income statement approach, we don't care what's in the allowance account. We're only interested in the income statement side. It says the company collected $1,500 from an account that was written off in year 6, the previous year. Recording this collection would include, so the account was written off in year 6, and then you later came back and collected it. So what would recording of this collection, what would be the entries to record this collection? Not bad debt expense, the allowance account. Good. Okay, does that make sense? Because typically, remember, we have to work around computers. And typically, a computer is going to record the accounts receivable. So what we do is we put the account back into accounts receivable first. So a customer comes back, pays a $1,500 account that we had previously written off. First thing we do is reverse the write-off. When we wrote it off, we debited the allowance account, credited accounts receivable. Remember that? So now that it's come back to be a good account, we're going to debit accounts receivable, credit the allowance account. So we simply reverse that entry. Then we record the payment. And probably it's going to be recorded in the computer. And of course, if we type in the computer that this customer came back and paid that invoice, computer's always going to make the same entry, right? Whether it's been written off or not. Okay, because now we put it back into the system. So when the customer receives, or that computer receives that payment, what's the entry going to be? Debit cash, credit accounts receivable. Okay, that's what it does every time, whether it's ever been written off or not. Okay, so to work around the computer, we're going to put the account back into accounts receivable, then record the collection the way we always would. Does that make sense? So the entry to recover that bad debt is debit accounts receivable, credit the allowance account, and then you record the payment as normal. All right, does that make sense? All right, let's see. Okay, all right, so let's look at recording an accounts receivable. We sold merchandise on credit with a list price of $8,400. Terms are 310, net 45. $8,400 sale. The terms, 310, 315. My brain says that didn't sound right. Net 45. Those are the terms. So we know that's not cash, right? Because it was cash, there wouldn't be any terms. So there's no cash involved. We did not get paid. So which of the following entries applies to the indicated method to receive the appropriate customer payment on February the 12th, which is within the 15 days? Okay, because see, the 310, what does that mean? 3% discount if received within 15 days of the invoice date. So if the price was $8,400 and it's 310.15, how much money did we collect on the 11th day? $7,140. Oh, I did 15%. That was crazy. Okay, so 3%, so times 0.97. So 8,400 times 0.97 is 8,148. Okay, so that's how much cash we would receive. Okay. Okay, so 3% discount if paid within 15 days. Now, I foolishly said, okay, 15% because I had the 15 in my brain, but it's a 3% discount, so I should have multiplied the $8,400 times 97%. Okay, right, less than 3%. Yeah, my brain just wasn't thinking. Okay, so we received $8,148 in cash. So we know we're going to debit cash for that because that was what we got. So, of course, there's two different methods that the company can use to record this sale, right? Either they use the net price method or they use the gross price method, all right? So we need to know how to record the payment depending on what method they used, okay? All right, so if it's net price method, when we made that sale, what's the entry to record the sale? To record the sale? Net price method means we record the account at net of the discount. So net price method, for this sale, we would debit accounts receivable for $8,148 and credit sales for $8,148. That's net price method, right? If we were using the gross price method, we would record the account at gross. We would debit accounts receivable for gross, and we would credit sales for gross, $8,400. Okay, net price method, gross price method. When we receive the payment, if the customer pays within the discount period and we're using the net price method, what's the entry? If he paid within the 15 days, we're going to debit cash for $8,148 regardless, right? Because that's how much we got. Okay, net price method, it went in at net. It's got to come back out at net, right? So net price method, there's your payment, right? Okay, does that make sense? It went in at net. It's got to come back out at net. That's net price method. Gross price, or that's if they paid within the discount period. What if they did not pay within the discount period? What is that? 252. Okay, so that makes sense. So if they paid within the discount period, this would be our entry. Okay, because it went in at net, it's got to come back out net. If they did not pay within the discount period, customer would pay us the full $8,400 because they missed the 15-day discount. it went in at net, so the accounts receivable still has to come out at net. So in that case, we're going to record a sales discount not taken, or our textbook would say credit sales. Okay, regardless, it's going to be a revenue account. Okay, I like sales discount not taken because I like to measure what gets measured gets watched in my world. So anything like that that you want to keep track of, you're going to put it in a separate account. So sales is fine, or sales discount not taken. Does that make sense? Because you received more money than you had booked under net price method. Okay, good. If it was the gross price method, we recorded the accounts receivable at gross. So we're still going to receive $8,148 if they pay within the discount, but the accounts receivable is got to be credited for $8,400 because it went in at gross. It's got to come back out at gross. Sales discounts gets debited for $252. Does that make sense? Because we need to debit in order to balance. So we debit sales discounts. What type of account is sales discounts? What does it reduce? It's a contra, not asset, contra sales. Okay? Okay. It reduces sales, so it's a contra revenue account. So what's the normal balance? Debit, because it's a contra revenue account. Does that make sense? Because it reduces sales down to net sales, so less the discount. Does that make sense? You're frowning. Process, right? Okay. So and it would be perfectly okay to debit sales, except I don't like to debit revenue accounts. And again, what gets measured gets watched. So we need to know how much sales discounts customers have taken advantage of. Okay. So if we're using gross price method, I like sales discounts. So that way we can track how much we have lost in the form of discounts to customers. Does that make sense? So keep in mind, if it went in at gross, it has to come back out of accounts receivable at gross. You know you're receiving less than the full amount of money. So you need a debit to balance the transaction. And that debit is a discount, sales discount. Okay, good? Okay. Then what if the customer does not pay within the discount period under the gross price method? I haven't deducted anything. I'm receiving $8,400 because they missed the discount, so they have to pay me full price. So my cash is $8,400. It went in at $8,400. The account has to come back out of accounts receivable at $8,400, so no further entry is necessary. Okay, so gross price method. Good? Okay. Okay, let's look at this one. Freeman estimates uncollectible accounts using a percentage of outstanding accounts receivable. After the year end for bad debt expense was made, the company's records and reflected the following information. It says accounts written off were $1,600. So my brain says, okay, I'm looking at the accounts receivable account. So I want to draw a T account. Let's see, I need accounts. Let's see, what is the question? It says the bad debt expense was made, the company's records reflected on the bad debt expense for the year was. So I actually need the allowance account. Allowance for doubtful. Okay. So it says accounts written off were $1,600. What's the entry when I write off an account under the allowance method? When I'm writing off an account, what's the entry? Writing off an account. So somebody contacts me, customer would file bankruptcy, account's no good, write it off. You're going to accrue bad debts. You're not going to touch bad debts at the time an account's written off. You're going to do that. You're going to match that in the period with the revenue. So when an account gets written off, what's the entry? You're going to credit accounts receivable, good, and debit. Say it. You know it. Say it. No, I'm going to. When am I going to touch bad debts? Matching principle says I'm going to record the bad debt in the period with the sales, not when the bad account goes bad. So bad debt was last year. I'm crediting accounts receivable. Why am I debiting? Did I allow for the fact that some of them are going to go bad? Yeah. So is one of them gone bad now? Okay, so what's my entry? Debit allowance for doubtful accounts for accounts that are written off. Okay, does that make sense? Okay. All right. So the next thing says collection on accounts previously written off. Collection on accounts that were previously written off. What's the entry when an account comes back? So they had filed for bankruptcy. Lo and behold, they come back, settled some of their debts. So they came back and paid me $300. What is the entry to record that payment? First thing I got to do is put the account back on the books and then record the payment. So what's the entry to put it back on the books? No, it's not. $300 is what I got paid. Right. So I have to reverse the write-off. So I'm going to debit accounts receivable and credit the allowance. Because remember, the write-off was credit accounts receivable, debit the allowance account. So if these accounts, if $300 worth of accounts came back and were collected, I'm going to debit accounts receivable, credit the allowance account. Okay. All right. Allowance for uncollectible accounts on January the 1st was $1,700. So debit or credit. That says the balance was allowance for uncollectible accounts on January 1st was $1,700. Where am I going to put that? Right, because what type of account is it? Contra asset. So normal balance is credit. Okay, so if my balance at January 1 was $1,700, it should be a credit balance. Okay. All right. Next, it says accounts receivable at December 31st is $100,000. All right, so I'm going to go back and read the question again. So it says estimates uncollectible accounts using percentage of outstanding accounts receivable. So we're estimating based on percentage of accounts receivable. After the year-end adjustments for bad debt expense, the company's records after the year-end adjustment for bad debt expense. So it says the bad debt expense percentage was 1.5%. So if I am estimating that based on uncollectible accounts using a percentage of accounts receivable, so it says accounts receivable was $100,000. And it says credit sales are $900,000. So that means debit accounts receivable, credit sales, right? So I have that. And then the next thing says that bad debt percentage is 1.5%. Bad debt percentage is 1.5%, but it says up in the verbiage, Freeman estimates uncollectible accounts using a percentage of accounts receivable. Actually, this is my accounts receivable at 12/31. 1,500 would be my estimated uncollectible accounts, right? Because it says that I estimate it based on my outstanding accounts receivable. And it says my accounts receivable at December 31st is $100,000. So if my estimate is based on accounts receivable, what's my entry? So 1.5%, I'm going to estimate that $1,500 of those accounts are going to go bad, right? This is balance sheet approach. So what does that mean? If it's balance sheet approach, that means 1,500 is what I want in the allowance account. If it was income statement approach, I would just do bad debt expense 1,500, credit the allowance account, right? Because I'm only interested in matching the expense with the revenue. But it says the 1.5% is based on the balance of the accounts receivable account. So that is balance sheet approach. Does that make sense? Now, tell me what that means. Okay, so you have to read it carefully. It says that the 1.5% estimate is based on the balance of the accounts receivable account. Okay, that's where the $1,500 comes from, 1% of the $100,000. So if it's based on the accounts receivable account, that's balance sheet approach. And the balance sheet approach, when we get that estimate, that's how much we want in the allowance account. Do whatever it takes to get us there. Right. So if it was the income statement approach, if it said your credit sales are $100,000 and we estimate 1.5% of those are going to go bad, we would simply debit bad debt expense for $1,500, credit the allowance account for $1,500. Okay, because income statement approach, we don't even look at the allowance account. We don't care what's in it. All right. But if it's the balance sheet approach, we do care what's in it. So in this case, since we're estimating 1.5% of that's going to go bad, that we're estimating that $1,500 worth of those accounts are going to go bad. So that's what we want in the allowance account. So now we simply have to. Sounds right. Okay. So we have $2,000 here with a debit. So that's a $400 credit. So we need $1,100 credit to get us to $1,500. Exactly. Okay. So what's the entry to get us to $1,500? Right. So when we do the estimate, that's when we debit bad debt expense. Okay. When we do the estimate. Right. On the balance sheet, we're adjusting the allowance account to the balance that it should be. Income statement approach, we're just interested in the income statement side. Okay, does that make sense? So in this, right, it would just be whatever percentage, and that's your entry if you're looking at the income statement account, the sales account. If you're looking at the accounts receivable account, that's the balance sheet approach, and that's when we have to calculate how much we have to adjust the allowance account. So the entry in this case is going to be debit bad debt expense $1,100, credit the allowance account $1,100. Make sense? Okay, let's look at this one. So, and this happens Companies, remember, operating cycle, right? Companies want to get that money collected as soon as possible. So sometimes they offer discounts to customers to pay early. They want to get back into that operating cycle as quick as possible so they can make more money on that money. Sometimes, in order to collect their money quicker, they will sell an account receivable. So they'll factor it out to a factor company, or they may sell it to a bank to collect that money quicker. Okay, so that way they could get collection on the account faster. So in this case, it says, oh, Martin and Lowry accepted $150,000, 8%, 90-day note receivable for services rendered to a client. So they did a job for a client. Client's not going to be able to pay within the normal 30 days, which would typically be an account receivable. So they sign a note that says, I'm going to pay you within 90 days. But when you sign a note, typically it includes interest. So this client signed a note for $150,000, 8% APR for 90 days. Do I? These days, it's not so much. A home mortgage right now costs you 8% now. Okay, so the first thing we have to figure out how much interest does the customer owe us. So 8% is a what? APR. What does that mean? Annual percentage rate. So that's how much it is for a year. Okay, that's how much it is for a year. Okay, so in order to calculate interest for a year, we take $150,000 times 0.08. So in order to convert that to a decimal, move your decimal place 2 places to the left and multiply. So the interest for a year is $12,000. Okay, and we need, actually, I think they're probably going to use a 360-day base because that's going to make it come out nice and even, right? Okay, so, and it could be either way. So you just have to look at it both ways. Is it a 360-day base or a 365? Banks use different. All right, so in order to calculate how much the interest is on the maturity value of this note, so multiply that times 90 divided by 360, so $3,000. I take the full amount times 90 divided by 360 because it's actually 12,000 over 1 multiplied times 90 over 360. %. So that would be the interest if it was an annual or a year-long note. And then we want to calculate if it's a 90-day note. And I'm assuming that it's going to be a 360-day base just because they made that come out to a nice even $12,000. Okay? We'll know here in a sec if we get this. Do what? Okay, does that make sense? So it says, the next thing it says 30 days later, old Martin and Lowry discounted that note at the bank at 10%. So what that means is they went to the bank and they collected the note less interest. They discounted it. So that means that the bank paid them, they took their interest out first. So instead of giving them $150,000, they calculate the maturity amount of that note. How much is the customer going to pay? Because the customer is going to pay the bank directly. So we're going to tell the customer when this thing matures, how much does the customer owe? $153,000. So when that note matures, they're going to send a check for $153,000 to the bank. So the bank, now I've gone to the bank, and I'm going to discount this note. So the bank is going to give me the $153,000 less the amount of interest that they want. They're going to take their money out first and give me the difference. Okay. 3,000, 12,000 times 90 over 36, or 360. It depends on what they're using. So I'm assuming it's 360, but it may be 365. We'll know here in a minute if we get the answer. No. No, I'm sure we're going to have one or the other. We'll know here in a minute. Okay, so the first, if we discount a note, first thing we have to do is calculate the maturity amount of the note. Okay, calculate the maturity amount, because this is how much the bank is going to get paid. Okay, so when they discount it, they're discounting the maturity amount because the customer is going to pay them 153. You got it? So that makes sense. That's how much the okay. Okay, but that makes sense, right? That's how much the customer is going to pay when this thing matures. Okay, that's the interest on it is $3,000 plus the 150, so they are going to pay $153,000. So this is the maturity amount of the note. That's the first step, is to calculate the maturity amount. How much will the customer pay at the end of this note? Okay, then the bank is going to take their interest out. Now, their rate could be the same as the customer's, but not likely. Okay, the bank usually wants more because there's a certain amount of risk, right? So they're going to charge you for the risk. So the bank is going to discount this thing at 10%. $1,530. Okay. But how many? That would be if it was a year, because this is an APR. So how many days am I borrowing this money? So it says 30 days later. So how long is it going to be now until the customer pays? 60 days, right? Because we sat on it for 30 days. So now the customer is going to pay the bank in 60 days. So we're borrowing this money for 60 days. Yep. Oh, yes. Thank you. Okay. So that's what it would be if it was a year. So now I have to calculate, because it's going to, their customer's going to pay in 60 days. 2550. Okay, so that's how much interest the bank is going to keep. So they're going to deduct that out of what the customer will pay them. I did, accountants are bad about decimal points. So the bank is going to write me a check for $150,450. Okay. Nope, that's exactly right. That's the answer. Debit to cash of $150,450. Just for ease. So sometimes textbook use 360 just because it's easier to calculate, and some banks use a 360-day base. Some finance companies use a 360-day base. It's just easier for calculation. But in reality, there's actually 364 and a quarter days in a year. So who uses that? Nobody. Okay, that's why we have to have leap year, right, in order to make up for that other quarter of a day. Okay, does this make sense? So what that means is that the bank is going to give us a check for $150,450. Okay. Sure. Just have to find a note. All right, let's look at this one. Obasi, let's look at this real quick. Obasi estimates bad debt expense using a percentage of credit sales of 5%. Percentage of credit sales of 5%. The company begins its current year with an $8,500 balance in the allowance account. During the year, $10,500 were written off, $1,200 were collected. Credit sales were $255,000. The bad debt expense for the year. Okay, ignore all the crap in the middle. Okay, what your brain should say, bad debt expense is a percentage of credit sales, 5%. So what's the other thing I want to know? How much is the credit sale? So it's $255,000. So if $255,000 are my credit sales, and I'm estimate the bad debts to be 5% of that, that's $1,200 or $12,750. So what's my entry? No, it says the beginning balance was 85,000. 10,500 was written off. 1,200 was recovered. But on the balance sheet approach, we would give a shit about that, right? But on the income statement, yes. So it says the bad debt expense for the year for $12,500. Okay. So what I'm getting you to look at is first line says estimate the bad debt expense using a percentage of credit sales, 5%. So we don't care anything about the allowance account. All we care is credit sales. So, and it says the last sentence says credit sales for the year are $255,000 times 0.05, $12,750. What's the entry? Debit bad debt expense $12,750. Credit the allowance account. We don't balance on the income statement approach. We don't care what's in the allowance account. We're simply going to record the entry for the amount multiplied times the sales. Make sense? Well, I mean, I can, if I need the board, so, but I can. Well, what I'm trying to get you to say is all that middle stuff don't matter. I am. I am asking for the entry. So what you want to, what you're interested in, bad debt is a percentage of credit sales. And then you have all this crap about the allowance account. Who cares? Credit sales are $255,000. So if we understand income statement approach, we don't care about all this middle stuff. 5% of $255,000 is $12,750. That's the entry. That's the income statement approach, because you're looking at the sales account, which is on the income statement. If you were looking at the accounts receivable account, that would be balance sheet. Okay, make sense? Balance sheet, because accounts receivable is a balance sheet account. Okay, so if it said that your bad debts are estimated at 5% of the accounts receivable balance, that would be balance sheet approach. And then we would be adjusting the allowance account to 5% of the accounts receivable. Does that make sense? Because you're estimating how much of those accounts are going to go bad. Okay. All right. All right. Let's look at this one. So Martin and O'Leary, here's a note. All right. Let's look at this one. Martin and O'Leary. Oh, it's the same thing. 90-day note. Services rendered to a client. 8%. Assume. Oh, and we discounted it to bank at 10%. So this is the same situation, just a different question. So the entry to record the proceeds. What's the entry to record the proceeds? Okay, proceeds from the bank. All right, so we know we're receiving that much money, right? Well, this is the same question. It's just that the other one wanted to know how much were you going to receive. This one wants to know what's the entry. That's how much we're receiving. We've already established that. Oh, no fair. They made it too easy. What a wuss. What a wuss. So disappointed. Let's see what the next question. I think it's also the same thing. Ooh, here we go. Here we go. Yeah, now what are you going to do? Now what are you going to do? Let's just record the entry. Let's just be hardcore. All right. All right. Where's the $150,000? Where is it on our books? Customer signed a note for $150,000. We're selling it to the bank. Come on, don't give up. Don't be a wuss. We're selling the note. Customer signed the note with us in exchange for a job that we did. So what was the entry? Debit note receivable, credit fee income, right? Because we finished the job, customer paid us with a note, right? Remember that was the previous. Well, right here it says we accepted $150,000 note receivable for services rendered. So when we accepted their note receivable and then fee income, there's the entry to record. Right? Does that make sense? Okay. So that's the entry to record. Right? Okay. So now we're selling that note. So we don't want to wait 90 days to get our money. So we took that note to the bank and we're selling that note to the bank. Anytime we sell an asset, what do we need to do with that asset? Get it off the books, right? Shaking your head is of no value at this point. Absolutely not. Okay. 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 I'm going to credit notes receivable because I sold the note, right? Okay. So note receivable, credit 150,000 because I got money at the bank. The bank wrote me a check for this, so I know that so far. All right. Then don't forget, I've earned some money, right? Anytime I earn money, what am I going to do? Anytime I earn money, credit revenue. I need to recognize that I have earned some money. What kind of revenue? Interest income or interest revenue, whatever they choose to call it. How much money have I earned? 30 days worth of interest, right? Because I held this note for 30 days and I earned 30 days worth of interest, right? So for a full 3 months, it was $3,000. So 1 month is how much money? 1,000. Okay. So I'm going to credit interest revenue for $1,000. I think that's got our answer, doesn't it? Right. But we're hardcore. Let's finish the thing. So I'm out of balance, what, 550 bucks? In order for me to balance. So this is what we call a what? Loss on sale of note. Does that make sense? So you can eat a truck, right? If you break it down in small enough pieces. Okay? Makes sense? You simply, same thing if you sold a delivery truck. The difference between what it's on the books and the amount that you receive is a loss or a gain. Same way. Okay? Does that make sense? So the correct answer. No, a loss is a debit because it's like an expense. If it was a gain, it'd be a credit because it's like a revenue. Okay? Does that make sense? Good. All right. Okay. Wondering's good. All right. That was 38, or no, or that was 37. All right, here's another one. You want to do another one? This is chapter 6. All right, here's another one. How we doing on time? I forgot my watch today. Before the next class, yeah. Okay, so so we accept it from a customer. Okay, so 8,000, and it's a 7% note. Okay, so what is that? 560. Okay, and that's for 60 days. So okay, okay, okay. So then that's how much interest I'm going to earn in the 60 days. So the customer's going to pay how much money? 8,093, right? That's how much they're going to pay. Okay. So then I'm going to discount that at the bank, and the bank wants to keep 10%. So the first thing they're going to do is calculate, okay, this is how much the customer is going to pay in 60 days. Bank says, okay, I want 10%. So 80930. But how many days are they going to keep it? Oh, it immediately looks like. Yeah. So 60 days. So sometimes we hold it, but in this case we didn't. $134.88. Okay. So how much is the bank going to write me a check for? So the customer's going to pay them $8,093. Their interest is that, so they're going to give me the difference. 8,093.33 actually, minus 134.88. So they're going to pay me 7,958. 7,992 is B. So why are we? Maybe it's 365. So that would be 9205 if it's 365. So that would be 80920. That would make that 134.87. 79.57. 79.92 is the answer. Oh, they give us the date. Shit. Oops, I said that on video. So it's 11th, and then on June 20th. So we held it for 15 days. Okay. Yes. So it's probably a 360-day base, but it's good thing we didn't find that number on there because we would have been wrong. And I was expecting it to say number of days. They have to be careful. So we sat on it for 15 days before we sold it. So the customer's going to pay in 45 days. 101.16. So they're going to pay $7,992.16. Yep. Okay. And I even looked at. Of course, I didn't really read it. You know how your brain looks at it but doesn't see it. Let me see that it's 15 days that we held it. Okay. Right. May do half and half. Okay. So what's the entry? We're hardcore, remember? So the bank's gonna. You're always going to have a loss on sale because the interest rate. We don't know yet. We have interest to record. So we need 15 days of interest out of this, right? So 93.33 divided by 4. $23.33 of interest. Is that right? Did you recalculate me or did you just? Okay. So we're selling the note, right? And it was $8,000. Now, when we received it, debit note receivable, credit sales, right? So now that we're selling it, we're going to credit note receivable. We're going to record the 15 days of interest that we earned before we sold it. So that's going to be the book value of the loan, 802333. Oops, 802333. And we sold it for this amount of money. $31.17. So loss on the sale. Okay. Good. Can do. We'll do one more or no? You got it? Okay. All right. Let's see. $6,500 note, 8%, 90 days. Okay. So first thing, calculate the maturity amount. How much is the customer going to pay at maturity? Then we go to the bank and we're going to discount it at 10%. So of course the customer is going to pay them the full amount and they're going to discount it at 10%. So $663. Now we have to figure out how long. So this time we're going to be smart and look at the dates. Now it won't be, it'll be closer to a month. So there's 14 days left in May, right? Because there's 31 days in May. Oh, it is 25 days. Why? It is 25 days. Okay. Of course, banks are going to go by the date. Okay. So 25 out of 360. It's been 25 days since we accepted it. So the reciprocal is going to be 65 days. So it's going to be 65 days until the customer pays the bank. So 663 times 65 divided by 360 is 119.71. So $6,510.29. Oh, the note was dishonored and the bank charged a $25 fee. So the bank gives us a check for this. Okay, bank gives us a check for this. So when we sell it, and then the note receivable was $6,500. Of course, we're going to record 25 days of interest, right? So 130 divided by 90 times 25. So 3611 is our interest. Say what? The 36, I just said 130 was for 90 days, and I wanted 25. 30 divided by 90 times 25 is 3611 is the interest for 25 days. No, divided by 90 times 25. Did I say it? I might have said it backwards. Okay. But I meant, okay, does that make sense? So you're getting 25 days worth of interest. And we earned that before we sold it. Okay. So that's the book value of the loan. And we sold it for $6,510.29, and then loss on the sale is $25.82. Okay, it's just the difference between the two. Yes. So now, that's we sold it to the bank. So then it says at maturity date the note was dishonored. Customer didn't pay, and the bank charged a $25 protest fee. The amount that Bruno would debit to note receivable dishonored is, so we owe the bank how much money? 66.30. That's how much they loaned us. Plus they charged us the $25 fee. So 66.55 is the amount that we owe. Okay. So this is how much the customer didn't pay. This is how much we borrowed from the bank, right? This was the loan. They kept 10% for interest, but this is how much we borrowed, plus the $25 fee. So now that the note receivable dishonored, we owe the bank the $66.30 plus the $25 fee, the $66.55. This is the note receivable dishonored. Sure. Okay, so you understand this, right? Okay, so you understood that this is how much interest the bank is charging, and that's how much the customer's going to pay them, so they wrote us a check for that. Okay, so all we have to do then is we got a check for that, right? And the note that the customer originally signed was $6,500. So that's the original note. So we're going to, because when we received it, we debited note receivable for $6,500. Now we sold it, so we're going to credit notes receivable for $6,500. And then of course we earned 25 days worth of interest. So out of the 130 for 90 days, those 25 days, we kept it for 25 days before we sold it. So I just took the 130 divided by 90 multiplied times 25. Or you could just say 520 times 25 over 360. Or you can just say the 25 days worth of interest on that note would be the 520 times 25 over 360. The interest rate. Okay, so the loss on sale is just the difference between what we had in it. So this is what the customer signed the note for. This is how much we earned on it. So this is the book value of the note, and we sold it for that. So the difference between the two is a loss. Right. So you sold it for less than it was worth. So that's going to make the loss. Okay. All right, let's see. All right, what about this one? Oh shoot, we got to switch. We got to change gears.